In early 2026, cryptocurrency markets were riding a wave of institutional approval. Spot Bitcoin ETFs were drawing in heavy volume, and the decentralized finance sector, or DeFi, had swelled to a massive $130 billion valuation. Over 13 consecutive trading days, $4.4 billion vanished from U.S. spot Bitcoin ETFs. Institutional money led the exit, slashing holdings by 17% and shrinking exposure from 313,000 down to 261,000 Bitcoin. Large-scale investors were looking past the usual volatility of price charts. They were reacting to a vulnerability in the system's foundational security that traditional risk models hadn't accounted for. This capital flight coincides with a new technological reality, a series of sophisticated high-speed breaches where decentralized code met generative artificial intelligence for the very first time. The cracks appeared in April 2026, when two massive breaches hit the DeFi space. Hackers targeted the Kelp DAO and Drift protocol networks, draining nearly $600 million in a matter of days. Investigators realized the attackers, linked to North Korean state groups, were deploying artificial intelligence to analyze blockchain protocols. The time it takes to scan software and find a critical vulnerability dropped from months down to mere hours. Large language models are now highly capable of generating and executing cyber attacks completely on their own, a process known as autonomous exploitation. Tech firms like Anthropic are actively restricting access to their most powerful models, like Mythos, precisely because of these severe security risks. This diagram shows the core structural flaw of blockchain under an AI threat. Decentralized protocols are immutable, meaning transactions cannot be reversed. An AI identifies a weakness and executes the drain instantly, long before developers can deploy a patch. Because DeFi is interconnected, damage spreads fast. Attackers used stolen Kelp DAO funds as collateral on Aave, sparking a panic that contaminated unrelated projects. Institutional investors watched an immutable financial system fail to defend against AI speed exploits. That systemic fragility is exactly what triggered the sudden $4.4 billion exodus from Bitcoin ETFs. As capital fled decentralized platforms, traditional financial institutions stepped in to offer a heavily guarded alternative. They were ready because of the Genius Act, passed in July 2025. That legislation created a clear federal framework, legally permitting chartered, regulated banks to issue their own digital dollars. This diagram compares the two models. On the left, permissionless stablecoins rely on separate reserve pools floating on public blockchains. On the right, tokenized deposits are exact representations of actual money inside a bank's ledger. Crucially, they carry standard FDIC insurance. If an AI threat emerges, the capital remains fully enclosed and protected within the traditional banking system. SoFi has already launched a consumer version called SoFi USD. JP Morgan deployed JPM Coin for institutional clients. And major commercial banks are partnering through the clearinghouse to launch a massive tokenized deposit network by early 2027. Wall Street isn't merely adopting blockchain technology. They are using this security crisis to pull capital back into centralized, bank-controlled ledgers. As the market settles in late 2026, the crypto sector is beginning to recover, but the power has shifted away from independent, decentralized protocols. For over a decade, the core philosophy of crypto was that code is law. But an artificial intelligence that can break code at superhuman speed renders that permissionless ideal completely indefensible. The decentralized revolution was built to bypass megabanks. But it proved so vulnerable to artificial intelligence that it forced the future of digital money directly back into the hands of Wall Street.